Hello everyone, today our group will present the application of AI and automation in banking. As technology continues to evolve, AI and automation are changing how banks operate. They help banks work more efficiently, reduce costs, improve security, and deliver better customer service. Today, we'll explain why this transformation is happening and how it creates value for the banking industry. So now let's dive directly into the background of the banking industry, which is currently undergoing a major digital transformation. Technology such as AI, machine learning, robotic process automation, and mobile banking have become essential part of modern banking rather than emerging technologies. These technology automate routine tasks, improve security, and provide customer with faster and more convenient services. Industry report also show how significant this change is. McKinsey estimate that generative AI could create between 2 and 340 billion US dollar of value each year for the banking sector, while the report while Deloitte reports that over 80% of banking interactions are now digital in leading market. This trend shows that digital transformation is no longer a choice, it's becoming a necessity for a bank to stay competitive. Based on these trends, our main argument is that AI and automation don't just improve banking, they fundamentally reshape it. They make banks more efficient by reducing manual work, strengthen risk management through faster and more accurate decision, improve customer experience with personalized and increase financial inclusion by making banking more accessible. In the rest of our presentation, we'll focus on two key areas where these benefits are most visible: AI in risk management and automation for reducing operating expense. And now let's begin with the first area, AI in risk management, presented by Kang and Ming. Will explain this topic in more detail.
Today, me and Min are happy to present Argument 1, AI and Technology in Risk Management. The core message is very clear. Thanks to AI and modern technologies, banks are changing from reactive risk management, fixing problems after they happen, to proactive risk management, predicting and preventing risk before they occur. Let me explain them step by step. With AI and technologies, banks can now move from reactive to proactive risk management. Let me explain what this means. In the past, banks usually reacted only after a problem occurs, such as a long default or fraud case. But now, thanks to automations and AI, they can predict and prevent risk before they cause serious damage. Automations and AI tools richly increase the speed, accuracy, and consistency of the entire risk assessment process. They can analyze large amounts of data in real time and provide early warnings. The benefits are very significant. One can reduce credit risk, operational risk, fraud risk, and compliance risk much more effectively than before. The quality of decision making is clearly improved because decisions are based on accurate data and smart analysis. Banks become stronger and more resilient when facing market change. In short, AI does not just help banks solve problems faster, it helps them prevent problems before they happen. These transformations make the whole banking system much safer, smarter, and more competitive in today's fast-changing financial world. To support this proactive risk management, banks first need high-quality data. This is where mechanization plays a very important role. The challenge today is big. The volume of transactions and financial documents is growing extremely fast. Checking all of them manually is too slow, very easy to make errors, and the results are often inconsistent between staff members. So, what is the solutions? Banks apply mechanization tools. This include document scanners, OCR, optical character recognition, and automated data entry systems. These technologies help banks convert paper documents and digital files into structured, machine-readable data very quickly and accurately. As a result, data collection becomes much faster and far more reliable. This high-quality digitized data creates a solid and strong foundation for the next step in risk evaluation. Importantly, without good input data, even when the most AI system cannot work effectively. That is why mechanization is considered the essential first step in building a modern and efficient risk management system.
So on the topic of risk management, I would like to point out the frameworks of 3 lines of defense. And for the usage of AI and applications, I would consider the use of them in the first 2 lines, the first line and the second lines. Since they are more common. And for the first line, that is the frontline operations. So this is where the team deal with directly with the daily operational risk. And therefore, I would like to point out the context of fraud and anti-money laundering. So for traditional systems, they rely on post-event batch processing, meaning that they can only catch fraud hours or days after the money has already been gone. However, with AIs, we can replace the system with the real-time streaming analytics, meaning that they can evaluate the live transactions right away, so that the AI can isolate and log suspicious activities right at the gateway. And furthermore, nowadays we will have financial criminals. They can use tactics such as smurfing, which mean that for smurfing they will wreck the large illicit funds into tiny amounts, and they will move the funds through the networks of the mule amounts to avoid detection from human analysis. However, if we use AI, or in specific the network mapping through the process of graph analytics, the AI can link the thousands of isolated transactions together, and they can build a behavioral webs that can easily expose the entire hidden criminal rings. So moving deeper into the systems, we will have the second line of defense, that is compliance. So for this team, they will be responsible for setting policies, monitoring risk, and internal controls. And nowadays, with the regulations of Basel III and Basel IV, the regulations can be changed rapidly, meaning that relying just on the manual legal reviews can be just too slow to update on the internal policies. And it can also leave the banks very vulnerable to the oversight of regulations, and it can lead to a massive compliance fees. So this is where the RegTech, or as I say, the regulatory technology, came into the situations. So RegTechs can help the banks to consistently update on internal BRE rules as soon as there's a change in the regulations. And at the same time, it can allow the data extraction process and can help to handle the reporting directly to the central banks, completely bypassing the manual paperwork. So one example of RegTech would be the coin project from JP Morgan Chase. So COIN stand for the Contact Intelligence. So they, instead of having the armies of legal teams spending months reviewing commercial loan agreements, the AI systems can extract critical clause from 12 complex commercial contracts, 12,000 complex commercial contracts per year in just a matter of seconds. So in terms of efficiencies, this means that the bank can save 360,000 hours of manual legal reviews every single year, while helping the systems to decrease the error rates down to near zeros. So in conclusions, on the topics of risk management, mechanizations and can bring us the absolute accuracies at the data layers, and on top of that, automations and AI can have this extreme speed and intelligence into the process. And by combining the elements together, we establishing a set adaptive defensive system, meaning that the systems will continuously learn, scales, and successfully safeguard banks against the unpredictable market volatilities.
Let's move to the second argument, automation reduce operation. Let's move to the overview of cost structure and impact on automation. Where the automation impact the bank's cost structure. Generally, a bank financial picture consists of three main cost categories: cost of fund, the cost of raising capital through customer deposits, issuing bonds, or interbank borrowing. This is heavily influenced by market interest rates and monetary policy. The second one is operating expense, daily operating costs, including staff salary, back office operation, and office rent. The third one is revision expense. Revision expense is cost set aside for credit risk and potential bad debts, which depend on economic cycle and credit quality. Automation mainly and most effectively impacts on operating expense, the area that rely heavily on manual labor and repetitive processes. Now let's look at the current problem existing in operating expense. Current issue in operating expense. Before implementing automation, banks face many bottlenecks and challenges in their operating expense, specifically personnel and back office. Employees spend a lot of time on manual data entry and transferring information between systems, for example, from PDF file to core banking. And these tasks are highly repetitive and time-consuming and prone to errors. KYC and AML stand for Know Your Customer and Anti-Money Laundering. Is manual verification of customer documents and blacklist screening still takes several days, causing delays in opening new accounts and monitoring transactions. Line processing. Customer must submit many paper documents. Staff have to enter data manually and go through multiple approval layers, resulting in slow line disbursement. And reconciliation. Manual end-of-day matching with Visa, MasterCard, and even let its conflict requires a lot of overtime and carry high risk of mistakes. In call center, staff are often overloaded with repetitive customer requests such as card locking, balance checks, and transaction status inquiries. This is a lead to a high staffing cost and reduced operational efficiency in operating expense. RPA restructuring operating expense. When banks apply robotic process automation, AI, and OCR, these operating expense areas are significantly restructured. Here's the main improvement. Back office. Virtual robot work 24/7 as many times the speed of humans. This frees up staff from repetitive tasks so they can move to higher value roles such as sales and customer relationship management. KYC and AML. eKYC combined with OCR and biometric AI reduce approval time from days to just a few minutes. AI algorithm also continuously scan millions of transactions to detect suspicious activities. Line processing. Digital lending platform automatically extract data from CIC, apply scorecard models, and make automatic disbursement decisions for customer loan and credit cards. Reconciliation. The system performs real-time matching and automatically flags mismatches so that staff only need to handle exceptions. In call center, chatbots and voice bots powered by generative AI can handle 60 to 80% of basic customer requests, greatly reducing the workload of human agents.
586,000 hours returned to its level. Roughly more are about 300 person years of manual work that no longer exists. So more than 20 billion Vietnam dong in workforce cost release. Also, the automation rate of 95% to 99% on the process they target. So you can see that number turn that theory into the business case. So 666% of ROI return on investment in 2024 alone. So these are the audit results of Techcom Bank. So which made them the first Vietnamese bank to win the award of operational excellence. So you can see that it is a very, very strong evidence of automation in banking industry. So to deep dive in this part and link to the previous theories, so there are four dimensions used by Techcombank. So the first one is reconciliation. So at Techcombank, costs reconcile tens of millions of transactions a day. So 1 million records match in 15 to 20 minutes. So no full manual review anymore. So the next one is the back office RPA. So I remember that we mentioned before about the robots running 24 hours a day at multiples of human speed. So in part operation, those robots may now process 600 to 1,200 customer requests every day with an SLA under 1 hour. So you can see that those requests that took 1 or 2 days come back to the same day. And because of the bot that touches the card data instead of the person, the compliance right now they will be actually improved about the confidential data. And the next one is the speed mutable is not a slogan anymore. So those tasks that took 2 to 3 days now they can finish in 2 or 3 hours a day. So at over 99% accuracy, running on a legacy core system such as Condor or SMS, CMS, and move to the final one. So the theory said that the automation frees staff for higher value roles. So you can see the tech company do exactly the same thing. So a human and a bot collaboration center yeah, I saw the example about like the 100%, 100 plus processing across 11, 11 units, scale from 5 virtual agent to nearly maybe 30. So the robots run the replication while the people do the judgment.
Let's wrap up with the big picture. Today, banks are moving away from small digital projects and embracing constant experimentation to keep up with fast technology changes. The digital front door is now the main way that the customers can interact, and AI is driving real-time and personalized engagement. The conclusion is clear. Automation does not affect every cost line equally. In banking, automation has little direct impact on funding costs and only limited influence on provisions. And its strongest effect is on operating expenses, where manual work and repetitive process dominate. By automating back office tasks, KYC or AML checks, loan processing, reconciliation, and call center operations, banks like Techcombank and TB Bank, as my teammates already mentioned earlier, have saved hundreds of thousands of hours, reduced errors, and boosted productivity. Beyond cost optimization, automation is transforming risk management. So mechanicalization improves data quality by digitizing documents quickly and accurately. Automation then accelerates and standardized risk assessment, moving bank from reactive responses to proactive prevention. AI engines score loans more consistently, monitor millions of transactions in real time, and detect fraud or suspicious activity instantly. And compliance reporting is automated, reducing errors and penalties while improving transparency. So the key takeaway is clear. Automation is not just about cutting costs. It is the lever that allows banks to redesign operation, strengthen risk control, and deliver faster, more personalized customer experience also. Those that embrace automation will not only optimize their financials, but also secure resilience, transparency, and long-term competitive advantage in the digital area. So this is the reference list that helped us to prepare this presentation. So that's the end of our presentation. Thank you for listening.